guys, I'm here again with Gabriel Possi, Tatiana Schotti, and Guilherme Cardoso, and we're very happy to be here with you again. So today we're gonna find out what's today's company that we're gonna evaluate financially, so you guys can understand a little bit more about finance. So let's see. Hello guys, how are you doing today?
I am great, Gabriela. Thank you so much.
Hi guys, happy to be with you again. So, I have a guest. Today we are gonna talk about Walmart, right?
So what's today's company? So we were wrong, but they are in the same market, right? So let's see today's straw. Who's gonna talk about what? Gabrielle is gonna talk about risk and return analysis. Nice! Working capital analysis. I love that. Guy is going to talk about financial ratios as he likes. Last but not least, Tati is gonna talk about shareholder value creation, which is very important.
Target Corporation was founded by George Dayton in 1902. It was previously named Goodfellow Dry Goods, but renamed in 1962. During the 80s, the store grew nationwide and the Target brand was released in the 90s. In 2000, the company changed to Target Corporation. The Target Company is a member of the S&P 500 index, and it is the United States' second largest retail store, just behind Walmart. The Target Corporation tries to differentiate their business by offering trending merchandise at a low price. They offer high-quality products at lower margins as the company focuses on diminishing their expenses. The company targets young customers, and 76% of the company's customers are females and 45% of them have children at home. They also focus on doing exclusive collections with famous people in order to increase their fashion profile.
Now I'm gonna talk with you a very important information regarding the year of 2013 because the Canadian operations were discontinued of Target Corporation, and also they sold their credit card portfolio to the TD Bank. Now I want you to keep in mind those two things because we're gonna explain it later. And this will be very important for our analysis, okay?
When people talk about liquidity ratio, people think about current ratio and quick ratio. Current ratio is the current assets divided by the current liabilities. In a sense, it is as if all the current assets turned into cash in 1 year time divided by all the liabilities that it will have to honor in 1 year. So if it is more than one, then the company is able to honor all the liabilities that it has in the short term. However, there is one line, one account in the current assets that it's not so easy to turn into cash, and it is inventory. That's why the quick ratio exists, because if we had to turn all the accounts into cash quickly, would we be able to, would the company be able to honor all its liabilities? Then it is the current assets minus inventory divided by the current liabilities. But in a sense, in this retail sector with huge companies as Walmart, as Target, and Walgreens, this kind of company can turn the inventory into cash in a few days, as the days sales outstanding is so low, the days of inventory outstanding is low as well. So it makes sense to calculate the current ratio for these companies.
In relation to the last 3 years, we can see that the ratio is decreasing. This means that investors are willing to pay less, in comparison with the past year, per dollar than they were. This can happen because they are perceiving a higher risk in that investment.
Now we're going to understand a little bit of the working capital of the company, which is very important to understand their financial situation. As we can see here in the graph, Target's working capital used to be high, and then it decided to decrease a little bit. However, as you all can see, in 2014 the working capital became negative. And why is that? It's because in 2013 Target sold all their credit portfolio to the TD Bank. From that moment on, Target sold its accounts receivable to the TD Bank, and began to receive in cash the amount for its sales. And by doing that, Target managed to make its working capital negative, which is very good for their financial status. By having a negative working capital, we can assume several things, such as that they can finance other things with their working capital, and also that they can manage their business better also. So we're gonna take a look at some ratios to see and to understand more about the negative working capital of Target. Now, having a look at the ratios, we can see that the Target has a lower day sales outstanding in respect to its competitors, and this is totally related to the sale of their credit portfolio in 2013. And however, we can see that they have also a higher days inventory outstanding and also a higher days payable outstanding. But what is very interesting and what's really important for the working capital is analyzing the cash conversion cycle, and that's what we're going to see now. The cash conversion cycle is the relationship between the three ratios that we were talking about. It is the sum of the days sales outstanding and the days inventory outstanding minus the days payables outstanding. As we can see here, Target cash conversion cycle is the lowest between the two competitors, Walmart and Walgreens. And what does it mean? Is it good? Is it bad? And that's what we're going to talk about now. Regarding the importance of the cash conversion cycle, first we must understand that it means the amount of time that it takes for the company to receive its payments after paying for the materials and inventory. It shows how much the company cash flow is tied up between the transactions, and it's a method to see how well is the business being managed. The lower cash conversion cycle, as we can see that it's the case of Target on the graph, is the best for a company's finance. So all companies look forward to having a negative cash conversion cycle, because it means that you don't pay your expenses until you receive from your sales, which also means that your working capital is being well run and there is available cash for other moves. So Target having a negative cash conversion cycle in respect to its competitors, it's really great.
Okay, hello. So now starting a little bit about the shareholder value creation analysis of Target. We'll start with the DuPont analysis of its two main competitors, Walmart and Walgreens. Starting with Walmart, we can see that the return on equity has been decreasing. And if we analyze the table, we can see that that is due to the fact that its net margin has been decreasing. This can indicate that the company's operating efficiency has also been decreasing. Now, talking about Walgreens, we can see that its return on equity has been unstable. So we had a growth from 2014 to 2016, but we had a decrease from 2013 to 2014. We can see that that is due mainly to the fact that the net margin has been decreasing. So just like Walmart, this can indicate the company's operating efficiency has been decreasing. However, as this growth has started to grow again since 2014, that is not something we can affirm for sure. Okay, so now talking a little bit about Target, we can see the return on equity has been unstable. The first noticeable point is in 2015 that we had a negative result of 9.88%, and this can be explained due to the fact that the net margin is negative. In turn, the net margin is negative because of the discontinuation in the operations in Canada that we have already talked about. So this discontinuation caused the net margin to be negative, which caused net income to be negative, which caused the net margin to be negative and caused the return on equity to be negative as well. However, this point is an outlier, so we cannot consider it as a truth for the whole company and all the years. We can see that the 2016 results are similar to the 2013 results, which can indicate that the company has started to grow again and had similar results to 2013. This result in 2016 can be attributed to the growth in net margin. They had a huge growth from 2015 to 2016 in the net income, which caused the growth in the net margin and the growth again in the return on equity. Also, talking a little bit now about the assets turnover, we can see that they are in an increasing tendency, and this happens due to the fact that the company sold its credit to the bank, like we already explained before, and due to the discontinuity in the operations in Canada. So we can see that the assets turnover has an increasing tendency over the last 4 years. Finally, talking a little bit about the leverage ratio now. It has been decreasing, and that can be explained due to the fact that the company sold credit. Because of that, it can finance itself with its own capital, so it doesn't have to have a huge debt. And now, if we observe the graph that compares the 3 return on equities of the main competitors, we can conclude that in a general manner, Walmart has a more profitable operations for its shareholders. In comparison, Walgreens has the worst results to its shareholders. However, Target had a better result than Walgreens in 2016, so that can indicate that the company is getting better and getting more profitable to its shareholders.
Here, it doesn't make much sense to compare the gross EVA between the companies, because if a company has an invested capital much higher than the other one, it can have the same EVA, but it doesn't mean that it's the same business, the same operation, the both companies are doing okay. No, it doesn't mean that, because if the invested capital is much higher, it means that the return on invested capital minus the weighted average on cost of capital is much lower. So, in this sense, to compare EVA among companies, it makes more sense to compare the difference between the return on invested capital and the WACC, the weighted average cost of capital. So this is why we compare here these two index between the companies to see which company can give more return to the companies using the others' capital.
But wait, Gui, I have a question. Which one of them has a higher return?
Well, Gabriela, it's a good thing you asked. So, the difference between the return on invested capital, which is the return that the company can give to its shareholders and investors, and the weighted average cost of capital, which is the return required by those investors. This difference is more evident for the Walmart company. This means that Walmart can give the best return to the money invested in its company. And Target has been the second best, but in the year of 2016, it presented a better result than Walmart. So this is a good sign for the company. When it comes to Walgreens, it has the worst performance, but it has also been increasing for the last years. So this is a good sign. And talking about Walmart, even though it has been the best for the last few years, the fact that now Target is a little better shows that they must be concerned about this, so they must understand why this difference between return on invested capital and weighted average cost of capital happened in the last year.
About the market value added, here's an observation about its relation to the price to book ratio. What's the market value added? If price to book ratio is greater than 1, market value added is positive. If price to book ratio is less than 1, the market value added is negative. But what's the market value added? What's that? Why is it positive? Why does the market pays more than the equity value to a company? The market forecasts the free cash flow of the firms and bring it to the present value. The present value of all the free cash flows of the firm is equal to the market value added. So if you sum the market value added to the company's value today, the equity value, the value of the sale of all the assets, it is the value of the company. This is what the valuation is when it's used the discounted cash flow method.
Thank you so much for explaining, Guilherme. Now that Guilherme explained to us what the market value added means and its relation to price to book ratio, we can compare a little bit of that ratio among the three companies. So, first of all, we can see that Target's ratio remained relatively stable along the years. The most noticeable difference is from 2014 to 2015, where it grew from 19,000 to 33,000. However, it's important to notice that all three companies had a growth in their market value added in that year, so this cannot be attributed solely as Target's merit. Also, Target's equity had also decreased from 2014 to 2015, which made the market value added increase even more. This decrease came mainly from a huge decrease in the retained earnings from 2014 to 2015. In sum, the fact that Target's market value added increased a lot from 2014 to 2015 is a good sign. However, it must be noticed that in 2016 it decreased again, so the company and its shareholders must pay attention to that. However, once again, we must notice the other companies' tendencies. Both Walgreens and Walmart had a decrease in 2016 as well. We can observe that Walmart's decrease was the most sharp of all three, so Target is not that bad after all.
Walmart has, over the years, presented the most stable ratio, peaking only in 2014. On the other hand, Walgreens had a growth during the years that happened more intensively from 2010 to 2014. It means that previously Walgreens was seen as riskier, but undoubtedly has improved its operations as investors almost doubled the PE in 6 years. Finally, we can see that Target had the most unstable value of PE during the past few years. This shows us that probably because the company had the most unstable results, investors are perceiving a higher risk in investing in it. As a consequence, the analyzed ratio is unstable, peaking only when all other companies also peaked. The retail segment presents betas lower than 1, which means the securities are less volatile than the market. Therefore, it is less risky to invest in these stocks than in the market as a whole. However, as the risk is low, the expected rate of return for the three stocks are also low. Walmart's beta of 0.48 shows that it is the less risky asset, followed by Target with 0.62 and then Walgreens. About the KPM, it describes the relationship between systematic risk and expected return for stocks. Walgreens presents the highest KPM among the three companies, with 10.74%, followed by Target with 8.09%, and then Walmart, with the lowest expected return. Target and Walgreens shareholders obtained negative results in the last 2 years, much lower than their current KPM. On the other hand, although Walmart presents the lowest KPM, its stock value variation was remarkable in the last 2 years. The mean value of Target's shares in the last 2 years was $63.63, with a standard deviation of $7.74. Moreover, it presents a normal distribution of its stock value variation. Target's share price have presented a low variation since 2015. In this period, the prices were concentrated between minus 0.5% and 0.5% positive.
Okay, so the conclusion of our work was to decide whether or not we'd invest in Target, and after a lot of discussion, we decided that we would. And that happens because the company has presented very stable returns all over the years. So its return on equity, for example, has been good. The only not so good result it presented was in 2016. So that's a really good sign for us investors. And also, this market is really stable, so it does not present so much risk for us investors, and that's exactly what we're looking for in this moment. So yes, we would invest in Target.